Thank you for joining us for the final Leadership Acceleration Series event of 2020. My name is Katie Pierce, and I'm the Marketing Manager and a Client Account Manager with the Resultants. I'll be assisting the team this morning with questions and monitoring the chat. I'd like to introduce DS+B CPAs and Business Advisors, a professional services firm dedicated to serving businesses, their owners, management teams, employees, and families in Minnesota and across the United States. They're a premier partner of ours, which means we truly believe in the work they do and would strongly recommend them for anything that you may need financially. Now I'm going to hand it over to you, Clint.
A little over 24 years. I'm a partner in the audit group, and I'm part of our executive committee in charge of finance for the firm. Our firm follows traction. A few little tidbits about me. I grew up in Iowa. Don't hold that against me. I have a twin brother, and my passion is bass fishing. I'm going to have the rest of my team introduce themselves as well. We're going to begin with Mitchell.
Clint is a good bass fisherman, even though he's from Iowa. Mitch Stolba, Rock Island Wealth Management. I've been doing this for 28 years. Live up in Rogers, Minnesota. One of my pieces about me is I've written a couple wild game cookbooks. If you'd like a copy, just let Katie know. Justin?
I'm Justin Spindler. I'm a tax manager with DS+B. I've been with the firm for 5 years and in public accounting for 12 years. I specialize in business and personal income tax and planning. And, something that you may not know about me is, I really enjoy kickboxing, got into it a couple years ago, and it's a great way to get a good workout in. John?
Yeah, I can tell you from firsthand experience that I've been on the wrong side of a couple of those swift kicks. So Justin is quite the kickboxer. John Cassens, I'm a partner in our business services department. I've been with the firm just over 10 years. Specialize in making owners' lives easier through technology and outsourced accounting. Little tidbit about me is, even though I might not look it in stature, I can promise you I'm not 6'10", but I played college basketball here in the Twin Cities. So,
I can assure you, John's a good basketball player. The only way I can score on John is if I'm shooting a free throw where he can't block me. As Katie had mentioned, if you do have questions, throw them in the chat box, and we'll look at them at the end, and we'll go through your questions at that point. The purpose today of what we're looking to do is provide you and share tips with you to build a holistic approach to your business and personal finances. To help you get what you want out of your business, we look at aligning your financial concerns from your back office accounting practice to tax planning to your personal investment strategies for retirement. Our first tip for you is you should have an all-inclusive meeting with your advisory team. We call this a CSP, a client success plan. You can call it what you want, but have a meeting, whether that's annually, twice a year. We like doing them at the end of the year so you can look forward to what's coming the next year. There's advantages to having all the advisors hear the same story from you versus having it go to your controller and then go to your accountant, then to your banker, back to the controller, back to you. Also a great benefit to have multiple heads working together for the greater good. Think of it as the Mayo Clinic experience. You would rather have multiple doctors working on you, not just one that's kind of good at stuff. So get that whole team together and hearing what you want them to know. In the meeting, you would have the team put together, assembled, similar to what we have today on the panel. You might have the audit partner, Mitch with our wealth management. You had John with the CFO plus and the back office help, and you had Justin in the tax group. In this meeting, you might also have someone from Resultants like Peter or Steve, Brian, maybe the banker or attorney. Your trusted team meets with you and your team, your CFO or your chief operating officer, whoever you trust in your operation to get everything done. Also, the owners have brought their spouse in sometimes. This can be therapeutic. It can also cause trouble and have another therapy session because of it. But have your trusted team put together and have everybody that you want to hear what's going on in that room. Mitch, you and I have done a lot of these meetings, and do you find it useful to have the spouses join the meeting?
Yeah, it really is beneficial to have the spouse be part of those meetings, and for multiple reasons. One, to make sure that there are, running on the same track, with the company too. but also if something ever happens to the business owner, is that they know who the rest of the team is, to make sure that they're working together, again, if something, whether positive or negative, happens with the business.
Yeah, the key is having everybody in that group know what's going on, right? And the only way we can get that is if the owner's sharing all those, what's your strategic objectives for the coming year? What current trends and issues are you dealing with, especially like COVID? That's a constant back and forth of things changing. You got to keep up with what's going on, and everybody needs to know where you're at and what you're thinking is at that time. What's your biggest challenges you're facing? What does the team have to do to, in your mind, make this a successful year? Team's going to help you resolve those issues and be proactive to get those things done and get you where you need to go. So make sure they know what you know, let them behind the curtain, so to speak, and make sure everything's covered with them in the room. The basis for these discussions start by looking at financials and hearing how a company is doing for the year. It can't be 3-month-old information. It's imperative that you have up-to-date recent financial statements. John, could you share with us some of the technologies that are out there that affect the back office and the impact that has on getting timely financials?
Yeah, of course. Thanks, Clint. Over the past handful of years, one of the biggest technology game changers has been centered around the automation for accounts payable and accounts receivable. AP automation, robotic process automation has created ridiculous efficiencies and potentially a reduction of even the number of employees that you have, which can ultimately save the business real dollars, right? One of the other pieces that it really has helped with is it's almost COVID ready, right? So these technologies no longer make you physically tied to the office. Again, when I'm talking about efficiencies here, streamlined processes around things that used to be very laborious, right? So it's not your old, I'm going to wait on snail mail, open the mail, put it in an inbox, mark it with a paid stamper, stuff an envelope and mail it out, right? So a lot of these technologies that are available specifically around those two areas, AP and AR, can certainly save your business a lot of time and save your employees a lot of time on more redundant processes. Not to mention delegation of responsibility. As business owners, we can all attest to we probably wear a lot more hats than just one within our organization. So the ability to delegate responsibility and keep information moving forward when you ultimately may be the bottleneck is certainly something that can be a big time saver for businesses and their back offices. Ultimately, the benefit to these technologies is getting those monthly financial statements by the 10th of the month, right? You're not working on post-mortem data that might be 30 to 45 days old or in the past. You have no ability to assess and correct business performance with financial information that's that far behind.
Yeah, I have lots of owners that are working with old information, and the point of this segment was to make sure you have a goal that you're going to get your internal financials turned around in 10 to 20 days. That's not uncommon. That should be expected from your team, and technology makes that possible. So having timely information is a must. John, it's exciting to hear about these new technologies and applications that are out there. Could you share with us how bill pay, this check approval, these new apps, how that affects the owner's freedom and their peace of mind?
Yeah, so one of our most important resources is time, right? It's the most precious, right? It's invaluable, and the ability to work on the business and not necessarily in the business is ultimately what these technologies and AP automation and bill pay can do to help that. You can approve bills, invoices, accounts receivables on the beach, on the golf course, to and from a sales meeting. You can check it anywhere and know that it's taken care of. Think of it like keeping your finger on the pulse of your company, right? For example, I've got a client in Indianapolis named Eric. One of the things that we uncovered during our client success plan meeting was his goal was to work only 2 days in the business and 5 days outside of the business, whether that be working on the business, finding acquisitions, riding his horses, etc. Right? That was his ultimate goal. And what we were able to uncover there is he was physically tied to the office, wearing a bunch of hats and not able to effectively delegate some of that responsibility. So just by implementing the accounts payable automation and the bill pay alone allowed him to ultimately achieve his goal of working 2 days in the business or physically tied to the business and his 5 days out. Now I've got a couple examples here that I want to show just how easy it is to use. So here's a couple screenshots that you've got for a bill approval, right? So on the left, you'll see what your dashboard looks like from your smartphone. It tells you specifically what your to-do items are. So, hey, I got an approved bill. I got 22 to pay. It tells me how many I have overdue or upcoming. You click on the approved bill, and it shows you a physical picture of the bill, who it's to, the invoice, the date it's due, and who needs to approve it, right? So there's an opportunity there to create an approval hierarchy so that way it might not be so dependent on you as the owner. And it's literally as easy as clicking approve from there. So some real life example of what that looks like. And now I'll show you just another example quick of paying a bill if you still wear that hat and you haven't delegated that. So here it shows a bevy of bills that are upcoming to be paid. You can go ahead and just simply click on one. It'll bring up the bill details, who it was to, who was approved by, how much it was. And right then and there, you can actually make payment, and it'll draft your bank account. So one of those pieces there that's extremely easy, and clicking a button, like I mentioned, from anywhere, not necessarily in the office, sitting at the desk, writing on the signed line.
Yes, especially in the cold Minnesota winters, who doesn't want to be able to do this from the beach, right? That technology makes it easy for an owner to get through all that. John, your team also prepares monthly dashboards. You know, what are those, and what's the benefit to the owner of using a dashboard?
Yeah, I'm glad you brought that up, Clint. So dashboards and KPIs, or key performance indicators, have been a big buzzword as over the last handful of years and beyond as technology has progressed. And what those can really do is assist in showing performance and in more real time, right? More leading indicators that you have. So really those dashboards and those key performance indicators are more suitable and readable for others in your organization, maybe your management team that you want to show those to, and the owners, right? It's a whole heck of a lot easier than reading a balance sheet, trying to make sense of it, looking at a profit and loss statement, okay, trying to make sense of that. And their key, as I mentioned before, to their usefulness is deriving those leading indicators of performance for your company at a high level.
Are those easy to set up, John?
Yes, easy. And the setup is certainly crucial. So the use of your management team, your other advisors, can certainly assist with that success in setting those up. And just remember, as you're biting off this little piece of technology or trying to implement these key performance indicators and dashboards, it's not etched in stone, right? You have the ability to adapt as business needs change your leading indicators as they come forward. Typically, during this process as well, there is some light bulb situation that occurs, maybe something that you had never seen before, never thought of before, what truly is a leading indicator for your business of success.
What drives that information there? Does that automatically populate once it's set up?
Yeah, ideally with the right mix of technology and finding what works with your current systems, which is key, because technology and systems and software can be a large expense and undertaking to shift a lot of those. But if you peel off just one little piece at a time and not bite off more than you can chew, there are certain applications out there that can help different systems talk. And that is pretty darn useful.
You got an example you could share with the group?
Yeah, so here, sticking with our traction model as well, here's an example of a key performance indicator wheel. right? So real time, pull it up on your phone. You might get an email in the morning as you're looking at these. You know, it tells you whether you're on track or off track for your financial goals or your business goals, right? Because this is not purely financial. It's things that can dictate what success is for the company. So this is one example of a nice visual graph on telling you where you're on track and where you're off track. And I got another example here of a little bit more financial metrics, but still aligned to the company goals. So you see a couple different areas here, profitability, activity, liquidity, cash flow, and growth. And it all takes your current financial information against your targets and hopefully tells you where you're on or off or need to potentially make some business course changes, right?
So pretty easy to see if my day's going good or bad, right? Green's good.
Green's good, red is bad. You got that one, Clint. So I think that's, you know, if you can read it, I think any of our business owners can.
Any way I can be of help there, John. Thanks for that update over on that end. We're going to move over to Justin a little bit in the tax group, which is, it's always top of mind. People are asking, you know, what else is out there? What can we be doing? What's changed? Justin, we know a lot of things have changed here in 2020, especially with the COVID. Is there something that employers can be doing to help their employees who might be struggling during this time of COVID?
Yeah, thanks, Clint. The President's Disaster Declaration he enabled back in March, that allowed employers to take advantage of Internal Revenue Code Section 139. And what this section is it allows employers to make tax-free qualified disaster relief payments to their employees. And not only are these tax-free, but they're also tax deductible to the business, and they're not subject to Social Security or Medicare tax. You know, one thing to keep in mind with these payments is that they cannot be a replacement for compensation. And so if they are, then they will be taxable. So with regard to these payments, the qualified disaster relief payments, they need to be reasonable and necessary expenses for the employee. And it needs to be COVID related or, you know, disaster related expenses. They can be reimbursed or paid directly. And an example of a few of these expenses might be the additional cost for setting up a home office. It could include childcare costs due to school closures or, you know, other childcare facility closures, personal protective equipment, and unreimbursed healthcare costs. You know, it's a very flexible benefit to the employees. You know, and you may be wondering, do I have to have a complicated written plan to be able to take advantage of this program? And you don't. It's not a requirement to have a plan, but we do recommend that you do have a plan. The reason why we recommend it is so that you can inform your employees about the details of the plan in the context of COVID. You know, you can detail out who's eligible, what expenses will be reimbursed, and, you know, potential limits, and also just how and when can they get the payments. So
it's not on their W-2, but the company gets to deduct it. So if the company spends, let's say, $10,000, they'll save potentially $4,000 in tax. Also, the employee and the employer both won't have to pay the Social Security match on that. So sounds like a great deal, something for everyone to look into. How about cash flow, Justin? Do you have any suggestions or strategies that companies can employ to improve cash flow?
Yeah, the CARES Act allows employers to defer the employer portion of Social Security through December 31st, 2020. Originally, you know, we didn't think this was going to be a very big deal because there was a limitation that if you were going to receive PPP loan forgiveness, then you were disqualified from this. But back in June, they passed the Paycheck Protection Flexibility Act, and that changed everything and opened it up that you could take this even if you had PPP loan funds. And so the deferral works where you would pay back 50% of it December 31st, 2021, and you would pay back the remainder of it December 31st, 2022. And it's pretty easy to take advantage of. What you would do is you would reduce your payroll tax deposits for the employer Social Security amount. And then it's all reconciled on your quarterly payroll tax filings, which for the most part, you may have a payroll company or someone else taking care of that. And I've been asked by a few different people, can we go back and amend and defer some of the tax that we've already paid in? Unfortunately, you can't. Once you pay the tax in, the deferral actually does not act as payments where it would actually generate a refund. So let's look at real dollars. How does this impact me? What kind of savings would I actually have? And if, let's say I have payroll of about $100,000 in a month, it'd end up being about $6,200 of cash flow savings. It could be a pretty decent help to cash flow if things are really tight. Now, moving on to this next piece, it's not only available to employers, it's also available to self-employed individuals, which this kind of came out and surprised me when I saw this. So the self-employed individuals can take a look at what their net self-employment income is from March 27th through the end of the year, and they can defer that and reduce their estimated tax payments. So it definitely is a great benefit for them. They would reconcile everything on their tax return and end up paying back 50% in 2021 and the remainder in 2022.
Sounds like a great way to generate cash during this time if needed. Case by case, everybody would have to look at your scenario, whether that's worth the hassle of having to take care of it and pay it next year, but if you don't have the money right now, that sounds like a great idea, something to look at. Now we're going to move over and discuss the PPP. This is probably the most widely discussed topic we've had in the last, 2 quarters. I bet people asking questions on this. So Justin, what should companies be doing to plan for the tax effects of the PPP forgiveness?
Yeah, the PPP program has been probably the most ever-changing program that I've seen. This started back in March, and it's been changing weekly since, it seems. Whether it's the 10th interim final rule or the next application available to participants. Even within just the last few weeks, Treasury came out with blanket forgiveness for under $50,000. We don't know if they'll bring that out to bigger loans, but at least that's a start, definitely to help out a lot of small businesses. What are some things that we should be thinking about if we're planning for loan forgiveness? There are 3 different types of forgiveness applications. There's the full application where you would report if you had any, employee or wage changes. There's the easy application where if you have no reductions in total number of FTEs and wages paid, then you can go ahead and file that. And then there's the simple application for loans under $50,000. So, one of the biggest questions we've had, when should you apply? And at this time, we recommend you move pretty slowly on this. With the election, we're waiting possibly for future legislation. Our hope is that they will end up coming out and correcting the intent of the law, because originally this was going to be a tax-free grant. And then the IRS kind of threw cold water on that and said, well, but the expenses are going to be non-deductible. So all we're doing at this time is we're holding out hope that they're going to come out and provide a little extra guidance. But let's say we do decide, I'm going to go ahead and apply for forgiveness. How do I go about that? A lot of payroll companies have provided reports that do a really good job of detailing out what your FTEs are, maybe if you had any wage reductions. And one thing I just want to impress upon you is that you consult with your CPA and have them look over the reports before you submit them to the bank. Because, I was working with John just last week. We had a client that they had an employee termination. They had bonuses in the first quarter, and all of that impacted the way that the payroll company analyzed the wages. And so what this did was this made it appear as if during the covered period that the employer had actually cut those employees' wages. And in the end, this would have resulted in about a $20,000 loan repayment. And, with a few corrections and adjustments, then it's all fixed and they wouldn't have to pay anything back. Okay, we're done with forgiveness. We see how much, however big our loan was, that's going to be income. How do we plan for that? Well, all we can do is plan for what we know today. And what we know today is it's going to be taxable. We've been preparing quarterly tax projections for our clients, And what this involves is taking a look at what their business activity is year to date. And then we layered the PPP on top of that. So we kind of give them both scenarios to help them plan for estimated tax payments, and also just to be able to plan for how much am I going to have to stock up for when April comes. So I'm going to pull up an example here just to kind of show you what some of the numbers look like. So as you can see in this chart here, we have a PPP loan of about $1 million, and with that we'd have income of the business about $360,000, and with the PPP is $1,360,000, and the total tax without the PPP is $180,000, and then the total tax with the PPP is $460,000. And one thing you might take note of is that the state tax is the same in both scenarios. And the reason for that is the state of Minnesota generally does not conform with the feds. They kind of do what they want. And so we're planning for that to be taxable regardless if the feds come back and allow the tax-free benefit. So, looking at these numbers, if I owed $460,000, I would definitely want to know today. And so I just impress, that you plan for this stuff and, really make sure you're looking out for what April's going to be.
Yeah, thanks, Justin. That's great information. Just to reiterate some of the highlights there, I have a lot of clients asking back with Justin and said, when do I pay for this or when do I apply for this? Well, the safe harbor date's on 12/31. If your FTEs, which are your full-time equivalents, you're comparing to February of last year to what they are when you were spending the money, there could be a reduction in your forgiveness if that went down. But they give you a safe harbor on 12/31. If you get your head count back to what it was, you don't have to do that measurement for the whole period that you spent the money. So kind of a convenience where you don't have to go back and calculate payroll by payroll whether your full-time equivalents were down. But it also gives us some indicators that would say you really don't have to apply for forgiveness before 12/31. You're still not done calculating the amounts. The other indicator is there's no requirement in the law written anywhere that you ever have to ask for forgiveness. However, in 10 months after you had your period of spending the money, you're going to have to start paying the bank back. So before then, you're going to want to look at asking for the forgiveness. But in our mind, if you can get past 12/31, there's a chance if it stays taxable, you're going to push that a year, which is going to help the owner's cash flow, not having to pay those taxes until a year later. So something to consider there. Aside from the PPP issues, Justin, as we get close to year end, companies are always looking, should I be upgrading equipment? What are the tax deductions can I take advantage of before the end of the year? Can you help go over a little bit over the bonus depreciation and what changes have come about, CARES Act and otherwise?
Yeah, thanks, Clint. If you're looking at a pretty significant tax bill from your PPP forgiveness, you might want to take a look ahead and see what kind of equipment purchases or improvements that you may be planning, let's say January, February. And you might want to make an attempt, if we're going to have the PPP be taxable in 2020, we're going to want to pull those expenses back and be able to take advantage of the full bonus depreciation or Section 179 write-offs. If we anticipate maybe we're going to be able to push this into 2021, then we'd want to do the opposite. We'd want to push the purchases off into that later period. Now, one thing that the CARES Act did was it fixed this retail glitch. Back in 2018, when the tax cuts were passed, they inadvertently converted the 15-year lease on improvements to 39-year write-off, which, that's a pretty significant difference. And with the CARES Act, they fixed that. They reinstated the 15-year leasehold improvements, and that allows a quick write-off for some pretty significant expenses. And, we also got another gift in the last couple of weeks when the state of Minnesota passed the bonding bill. They put in about a paragraph worth where they stated that they're going to conform to Minnesota to the federal 179 limits. And what does that mean for you? Well, that means that you can write off a little over $1 million of fixed assets in a year, and you also get to take that benefit on Minnesota. Why is that significant? In the past, you could only take 25,000 of 179, and you'd have to add back 80% of the difference as income. So it ended up being kind of a big effect on Minnesota, where you might not owe anything on the Fed, but on Minnesota, you'd always get slammed for a bunch of taxes. So it's definitely a lot of things to take advantage of. Plan for year end, plan for the big tax balances due to PPP, and just make sure you're looking forward.
Great, Justin. Thanks. Another topic that's been asked about throughout this time too has been unemployment. I get asked a lot whether we should be considering furloughs or layoffs. You know, my first advice is you probably got some C players that aren't performing, and maybe you should be letting them go anyway. So that's where your layoffs come, taking care of those C employees that shouldn't be there anyway, probably. The B employees, you know, the furlough is a better option. For one, it's short term. Plus, it wasn't that long ago, you know, we were struggling to find employees. A lot of people have been looking for the good ones. So if you do have ones that are good, try to keep them happy. And if you have to furlough, you know, try to make it easy on them. Keep those A's and B's, you know, ready to come back when the turnaround comes. And remember, the other employees are looking at how you handle these layoffs and the furloughs. So they're always going to be asking, hey, am I going to get treated this way? Am I next? What's happening? So keeping people informed and letting them know this is what the company's doing. This is why we're doing it. This is, you know, set out a certain amount of time. We're doing this furlough through 2 months from now, and then we're reassessing. Always let them know you might be looking later so they know it's not forever, right? So, John, you know, if companies do have to furlough or lay people off, you know, what's the latest updates on unemployment? What's going on there?
Yeah, thanks, Clint. Be aware that Minnesota, Wisconsin, a lot of states around the country have what's called a work share or a job share program. So essentially what you can do as a business owner is you can cut hours if your business has been brought down due to COVID. The employee works, say, 30 out of the 40 hours in the week, which you pay them for, and then the unemployment kicks in about 50% of the missing 10 hours to bridge that gap. Now, what this does is it keeps employees working, it keeps jobs safe. It's really an alternative to having to fully furlough or terminate employees. So you utilize the state unemployment offices to apply for these work shared programs. You can determine your length that you want to have the work share available, and you can also extend come time as you near the end of that term. Now, one of the things that occurred for a client of mine as well was they were significantly impacted by COVID. They didn't want to lay off. We had just received the PPP funds, and doing this work shared program, we were able to pay the employees for, let's say, 32 out of their 40 hours and have them still kick in some unemployment benefits, which for us, it didn't look like we reduced their wages by greater than 75%. So we were still able to keep our workforce going, not affect our PPP forgiveness while taking advantage of a program that was available here in Minnesota.
Yeah, great way to take care of those employees, especially because you're going to need them when things pick back up. So thanks for the update there, John. Those are all great tips for the company. Now we want to shift gears a little bit and take a look at what this means for the owner. We need to align everything that we just talked about with the owner's plan. This starts by knowing the plan. Mitch, I know when we're out with clients or new clients, you're always asking them, you know, what's your plan? What's your number? You know, what does that mean?
Yeah, thanks, Clint. It's a great question. You know, been doing this for 28 years, and if I reflect back over and look at the .com, 9/11, 2008, and the recent pandemic, for some reason, a lot of business owners start talking about, hey, I think I want to get out, I want to retire. And so when they start looking at selling, they really also have to understand how much do they need to net after taxes in order to live the lifestyle they're accustomed to. So we had a business owner that we worked with, lives over in Hudson, sat down with he and his wife, and we had to figure out is, you know, what is their spend? You know, how much are they spending each month? And actually, how much money were they running through the business? And so once we figured out what they needed after taxes for income, we could come up with a number, which is just, it sounds odd, it's just under $9 million they needed a net after taxes when they sold their business. A lot of our companies are EOS traction companies. They do a great job with their VTO building their plan for the business. They also need to take time and sit back and really look at what their number is, what their plan is for their end game and for retirement, and also making sure they work with the right team. Katie, can you show that video of maybe you want to have somebody else on the team?
Hello?
Honey? Are you at the club?
Yes.
I'm at the mall now and I found this beautiful leather coat. It's only $1,000. Can I get it?
Well, sure, if you like it that much.
Okay. I also stopped by the Mercedes dealership and saw the new model. You know, the one I really
How
like.
much?
120.
Well, at that price, I want it with all the options.
Great. Oh, and one more thing. The house we wanted last year is back on the market. They're asking 1.5.
We'll make them an offer. But come in at 1.4.
Okay. I love you, baby.
I love you too.
Okay, bye.
Does anybody know whose phone this is?
I mean, you gotta love it. I mean, I laugh every time I watch that video, right? Not 1.5. Let's come in at 1.4, right? So making sure that you really reflect on putting together the team. You know, look at that number, you know, and have a plan put in place. And again, going back from the opening conversation, make sure your spouse is actively involved in that meeting. So typically, we circle in, you know, the trusted advisor, CPA, attorney, banker, and everybody else to make sure that we work on that number, work on that plan.
Yeah, make sure it's your spouse, or it might cost you even more there. So
that's
funny
a whole
video
other
there,
conversation.
Mitch.
Yeah.
Great advice, great advice. That's the end game, but let's talk a little bit about the middle game, right? So saving taxes and wanting to diversify and setting money aside for retirement are all things that owners look to do and want to do. You know, Mitch and I shared this client, you know, we did a CSP with him, and he brought up a concern, you know, all my wealth's tied up into my company. You know, I've never put any money aside. I've never set anything into retirement. I don't really have any money in my bank account. You know, if I need it, I take it out of the company, but everything I have, I put back in, and it's all sitting in the company. You know, some of you owners may be in the same boat. You know, one solution we brought up to them was a cash balance plan, and not everybody's heard of these, but Mitch, maybe you can explain and help the group understand what a cash balance plan is and how it works.
Yeah. So a lot of companies have a company-sponsored retirement plan, a 401k plan, and the 401k is probably, you know, is a great vehicle for not just tax deductions, but also for building wealth. So in a 401k plan, individual can defer up to $19,500. If you're age 50 or older, you can defer $26,000. And actually, those new numbers, those new index numbers, should be coming out here in the next couple weeks for 2021. Then on top of that, maybe you've got a safe harbor match or a safe harbor non-elective where you're either matching up to the first 5% or you're doing 3% for everybody. And then on top of that is profit sharing. And so that's, you know, and that's the 401k profit sharing plan that you have inside there. A cash balance is basically a separate account. It's a defined benefit account. It's a pooled account that allows individuals to defer a lot more money. And Katie, if you could you pull up that example? Then I can just show you a real life situation that we worked on a client here a few years ago. Now I know the 401. If you look in the 401k column, those deferrals are a little bit older numbers, right? But here we had a husband and wife that had 4 other employees. And don't worry about the size. I've got a lot of bigger companies that do this too. An interesting point on this one is that the wife was only, you know, had a $30,000 salary. Initially, she wasn't even employed. He brought her in and then had her help out with the company. And so now we have their wages, and they have those wages at that level in order to put the most money away. So we got $275 for wages. We've got the 401k deferrals. We've got profit sharing. If you look at that cash balance portion of it, you can see how much more money goes away into their bucket, right? and then look at what they have to put away for the employees on the cash balance plan, right? So if you combine everything, both, the cash balance, profit sharing, and 401k, that's over $500,000 of tax deductible savings. If you don't like paying taxes, consider a cash balance plan. If you do like paying taxes, then don't. But it's a great way. If you figure they're saving $200,000, give or take, as far as on taxes when they add the cash balance plan. And the cash balance plan is a separate account. It's not pulled in with the 401k, that part of it. The other part of it is that what you have to think about, thanks, Katie, you can pull that down, I appreciate it. Look back at COVID, right? A lot of individuals, business owners are relying on the sale of their company sometime in the future for retirement income. I'm going to sell this, built this up. Here's what everything is. There's a lot of companies right now today that virtually don't have half the value that they had before with the COVID, right? Now I'm not sure what future pandemics are, but this is a great way to start pulling money out and diversifying your wealth and put it into not only just the 401k, but cash balance plan. With the cash balance plan, you can set this all the way up until the end of the year. I recommend that if you're going to set one up, that you do it sooner than later. They don't have to be funded until you file your taxes, including extensions. So like you can do it all the way up till, next fall, you could fund it. But it's a great way to, pull wealth out of the company, build your own wealth, right, for retirement, and save a lot on taxes. You just saw in that example there, $200,000 in taxes that more than paid for the other employees, and really saved a lot more money for them too. And the size of the company, I've got individuals that are self-employed to, large companies that are doing this for retirement.
Yeah, as we get to the end of the year, people are always looking at, okay, if I spend money at the end of the year, how can I reduce my tax bill? This is one of the great ways that you could actually be spending money, but it's actually going in your name. So that tax savings, if, back at the example, the majority of that money went into the owner's names. So you're deferring that tax till later, they'll have to pay that when they use that money, but time value of money, having that money separated and having it out in a secure place as well, right, Mitch? They can't access those in any kind of bankruptcy and stuff, right? All protected.
Yeah, they're creditor proof. Proof, yeah.
So great way to get, accomplish those goals that we had talked about, saving money and building up wealth at the same time. So something to consider. We've also worked with clients, Mitch, on understanding their liquidity and their estate needs. We have something there that we've been working with. Mitch, could you let us know what premium financing is and how that works?
Yeah, let me start a little bit before I kind of go with the premium financing, why people even consider, using premium financing. And so when you look at estate planning or you look at liquidity needs upon the death of a business owner, right? So let's just talk about estate taxes currently, right? Each individual can pass away a little over $11 million. So a husband and wife, you're talking just about $23 million. However, that sunsets on 2025, right? Goes back down to $5 million. Anything above, let's just say that we're sitting here in 2026, anything above $5 million per person is subject to 46 cents on the dollar, okay? That's for Fed. On the state of Minnesota, right now we're at 2.5. It'll probably stay at 2.5. Anything north of that per individual is subject to 16 cents on the dollar. Estate taxes are due within 9 months of the second death, right? So what you have to look at is liquidity needs, right? Also, what you have to look at is, I've got a client over in St. Paul, owns a lot of real estate. Started talking about his needs for liquidity. He has call provisions on his loans on these different buildings. If he passes away, those loans are callable, right? They can call those loans. And so if he passes away, his wife's got to okay, do I need to sell real estate? What do I need to do? I think they can work something through that, but just so he knew that there was liquidity needs also. And then also there's maybe other philanthropic, or maybe we do a lot of special needs planning, right? Maybe you have a special needs family member that you need to make sure that you have something there for them in case something happened. Which brings up, I'm going to talk just real quick on special needs planning. If you have a special needs family member, make sure you do not leave them direct beneficiary of any assets. Make sure you set up a special needs trust, okay? If you do not and you name them directly as beneficiary, that disqualifies them from government aid. So again, we do a lot of special needs planning. Make sure that you work on set up a special needs trust in order to make sure that they don't disqualify them. So if you've got a liquidity need, if you're going to have estate taxes, what you want to consider is how are you going to create that liquidity? Do you need to sell the business at a discount? Do you need to sell real estate? A lot of options I recommend is setting up a life insurance trust. An irrevocable life insurance trust. Life insurance is held inside that irrevocable life insurance trust, and you want to have it in that trust so it's out of your estate. Now, when I start talking about insurance, everybody goes, well, you know, and I'll say it too, insurance sucks until you need it, right? And I don't like paying the premium. So if you have the ILIT or that trust inside there, and I'm going to use an example that John and I are working on right now. McDonald's owner, we need about $20 million, okay, of liquidity. And it's about $1.3 million of premium that he's going to pay for 10 years. Now, he can pay that out of pocket. However, with premium financing, because of his net worth, he can borrow that money from a bank along with the interest and let that money roll up. So the premiums are paid by the bank. The interest is credited to those premiums, and that goes on for 10 years. Inside that permanent life insurance product, that money grows tax deferred. And so how we look at it right now, about year 13, he's going to take a loan from his life insurance policy to pay off the loan from the bank. It's a non-taxable event. You take the loan from the life insurance policy, which is a non-taxable event, and pay off the loan along with interest to the bank. Now he has a fully paid up policy. He doesn't have to pay any premiums. Virtually no money out of pocket to him. Okay, so again, borrow from the bank to pay the premium. You could pay the interest going forward, or you can actually have it rolled up. In this case, we're having it rolled up inside there. And so in about 10 years, that's how long the premiums are. He's got and then in year 13, I think is how we forecasted it, is that the money comes out of the cash value to pay off that loan. And then he's got a fully paid up policy in an irrevocable life insurance trust. And obviously when he passes away, there's $20 million that goes back to his beneficiaries, income tax free. So it's a great way to leverage if people have that type of net worth in order to do that.
Great way to not have to spend your own money and still accomplish all your goals there. Very, very interesting topic there. If anyone wants to hear more about that, you know, we're happy to talk to you about it. But another one of those gems that you don't hear a lot about. So great information there, Mitch. I have one final question for you that I get asked a lot by people, especially as they get close to retirement. You know, when should I start taking out my Social Security?
Yeah, Social Security. So one piece that you may want to write down is that they don't send out Social Security statements anymore. You need to go to ssa.gov. Again, that's ssa.gov. And the reason you want to go on there is you can sign up and look at your statement online. And we all know the government doesn't make mistakes, right? That's supposed to be funny, but anyway. So go on there. You want to make sure that they have your name correct, right? If you, ssa.gov, as in gov, thanks, Katie, is that you want to make sure that they've got your name correct, especially if you've been remarried, they've got your address, they're going to have your date of birth, the last 4 digits of your social on that statement, right? And they'll also show you what your earnings history is. So whatever you're at age 62, what your full retirement age is, and then at age 70, and then it stops increasing from there. And then I'll show you, again, I'll show you your earnings history as far as they take the average, you know, basically it's about 30 years of your earnings to calculate your benefit. You can only go back 3 years to ever fix that. So if there was a mistake for some odd reason, you can only go back 3 years. So let's say in 2019 or whatever, they for some reason they didn't, you know, credit you your SSI income, you can go back 3 years to fix that. Another interesting point too, and I'll get to your question here, Clint, is if you've been married for 10 years or more but now divorced, you actually can qualify if your spouse's benefit's higher former spouse's benefits was higher, you can actually take their Social Security, and then so you get half of it, but when they pass away, you get the full benefit. But if you do remarry, it doesn't work out. Interesting point. Johnny Carson has 4 wives. He had 4 different wives that he married for 10 years or more that are all taking his full benefit. It doesn't reduce it. Obviously, he's passed away, but they all 4 were taking his full benefit. When you start talking about Social Security as far as when to take it, it's different for everybody. Again, at certain income limits, 50% of your Social Security is taxable. At other limits, it's 85%. You may want to have one individual start now, one start later. Everybody says, hey, I'm gonna wait till 70 and then I'll start taking it. I always challenge people a little bit and this comes back into, family history. On average, how long has your family members lived? And let's say that typically the crossover point, if you wait to age 70, is get out to 88, and that way your benefit's going to be higher than if you took it sooner. And so making sure you really look at that, look at what your other income sources are, when you're going to take those out, and really understand how Social Security fits into that.
Great information, Mitch. Appreciate all that. Just kind of wrapping up, each of us are going to kind of give us a summary of some of the takeaways to look at. My example for having a CSP meeting, and we had a client, let's call him Pat. We were meeting with Pat, and in this meeting, somewhere down the road, his kids aren't going to want to come into the company. So he knows he's going to want to sell the company. So we're looking for options that he could get some of that wealth, when this sale happens. Let's say it's going to be 5 years down the road. How does he transfer some of that to his kids? And we had discussed, an option of giving the kids some stock. If they had ownership in the company, we'd be able to transfer some of the proceeds in that sale directly to them, and they're going to be in a lower tax bracket. Plus, it's going to get the money in their name and move some of that wealth. Then we talked about not having these be voting shares. So, Pat could still retain control and make all the major decisions in the company in the meantime. Some of the impact of that is, having multiple owners, they're going to share in some of the distribution and some of the cash flow now. So he had to be okay with that. And there's going to be tax consequences on both sides, the owner and the kids, during this period, as well as during the sale. Not something that's going to fit for everybody, but it's just showing that having these meetings and working out what's in the owner's mind, what's he thinking, what's important to him. What's important to him was to get wealth moved over. He does want to understand the impact of what he's doing, but sometimes you got to drill down and to find out what's the most important piece. And then tax might not be the #1 driver in that scenario. Your scenarios might be different. The point is, have these meetings, make sure everybody and the advisors are hearing directly from you. You can never communicate too much. Maybe Mitch and John and Justin, if you could give us some of the takeaways for the group.
Well, maybe many of you belong to a country club. You may not want to have the locker next to you be your, put your plan together. Now I would say, start thinking about what your number is, what your plan is, and make sure that you work with all of your trusted advisors to make sure they're on the same page. If you don't like paying taxes, consider a cash balance plan. And then work on your estate. It's one of the things that people kind of push off last. If you're interested in learning more about premium financing, just let Katie know. We can work with you on that. And then if you want a cookbook, like I said before, I can get you a cookbook.
Hey, maybe your plan's just to marry Johnny Carson, get in line with the Social Security tap there.
John?
Yeah. In summary, get your time back, right? Your biggest resource as a business owner is your time. Find the ability to work on your business and not necessarily in your business or what you truly like to do. So find some technology efficiencies that you can within your business currently to get back that resource. Get your financials more timely. You cannot make a decision on information that's 30 to 45 days behind you. Bridging that gap can certainly set yourself up in business success a little bit easier.
All right. Yeah,
Justin.
just a few things regarding some of these changes from COVID and everything like that. Take a look at the qualified disaster relief payments. If you have any employees that are really struggling, this is an ongoing qualification that it'll be open. And, you know, we don't know how long COVID's going to last. There could be some unexpected expenses, things like that, that come up for employees, and you could definitely take advantage of helping them out while also being able to deduct the expenses. If you're running into any cash flow needs, take a look at the payroll tax deferral. You have until December 31st to take advantage of that. So that's always worth a second look. The biggest point, PPP, it's going to be on everybody's mind over the next couple months. Start planning for forgiveness, whether that be what application do I need? Who do I need to circle around me to help me with this process? And just plan effectively for your taxes. There are a lot of things that you can take advantage of, and make sure you're considering them all so that you can, you know, get that tax bill down, or you know, defer things into the future a little bit.
Great advice, guys. I hope everybody on the webinar picked up some great tips that they can apply to their situation or their company. As you heard, tax savings, those opportunities such as the cash balance plans, the premium finance, deferring payroll taxes, bonus depreciation. The goal in a lot of this advice is savings on taxes, right? So happy to discuss any of these topics further with anybody. We're going to take us a minute here and look through the chat room. So if you have more questions, go ahead and throw them in the chat room. Our team's going to look through some of these here and start answering some of them. So keep putting them in if you have them.
So I can relay these if you want. So the one question is the FTE count for the PPP forgiveness a simple single day count, or is it averaged over time?
Kind of. Nothing's always simple, right? So during the time that you're spending the money, so that was 8 weeks when this all started. They shifted that to 24 weeks. While you're spending that money, there was measurements that was like, okay, your head count, you couldn't be reducing the amount of money you paid people, and you couldn't be reducing the number of people you were paying. And that match was comparative to what it was before this all started in February. So while you're spending that money, you got to test each person. You know, if they worked 30 and they had been working 40, you know, that's a 25% decrease. And you had to measure that on each person. What they threw in was a safe harbor day and said, okay, but on 12/31, I'm not going to make you go through that pain of checking it day by day by day through the whole period you spent the money. If on 12/31, you're back to where you were. So some of the clarity things we've been asking the SBA to feed back on, and they haven't. Our questions on January 1, do you care? On January 2, do you care? Because on 12/31, I can make sure my FTEs are exactly what you said they need to be. Are you going to care a week later if I put them to where the company needs to be at that time? So I don't know, John, Justin, do you have any other feedback on that?
Yeah, with the FTEs,
Yeah, so,
or John, okay. Like the payroll companies are doing calculations for a lot of this stuff. So just reach out to them, or, you know, take a look. If you don't have that available, you know, it's just, you just have to look at different periods, look back periods versus the cover periods, and compare that, and just make sure that you don't have the reductions. There are certain outs. If you have under 50,000 of PPP loan, then it doesn't matter. If you were affected by shutdowns and other COVID related matters, there's also an out where you can, you know, use the easy form and you kind of avoid that whole mess. The overall goal for anyone with PPP funds, you don't want to have to do the full application where you have to supply showing that you had reductions. And so you just kind of exhaust any option you have to avoid that.
And those forgiveness forms, Justin, that's where they're going to outline your covered period and your look back period. They're going to define that for you, right, on those forgiveness forms when you're filling those out?
Yeah, it's you know, a lot of that stuff I've seen it come from payroll companies as well, where they'll identify what your most advantageous look back period is, because you have an option. You can look at 2019, you can look at the first quarter and compare that to your covered period. And so those are kind of the critical periods to look at to see if you had any reductions or whatnot. But you know, from what we've seen, even on those reports, even though as good as they are, we've had to make some adjustments for people that are terminated or adjusted. And I did see just yesterday helping a client look at their reports. They do have little disclaimers in there that says, you know, if you were affected by any of these situations, you may need to make some manual adjustments to the reporting.
And Jerry, just to jump back to your question real quick too, is it is averaged over time. So they look at full-time equivalent count over a monthly period on your covered period, right? So that is kind of the calculation that is out there. And that full-time equivalent count, to Justin's point, in payroll reports isn't gospel, right? So if you fired someone for cause, right? If they requested to leave because of COVID-related reasons, if they quit, you get a full-time equivalent exemption for that person. So that's why we suggest here, look at the payroll reports, right? Discern if something doesn't look right. If you have any reductions, you may want to vet that out a little bit more. But in regards to your question, Jerry, it is averaged for full-time equivalents over monthly periods during your covered period.
Good stuff, guys. I see a question here, Mitch. I'm going to jump to you. The question is, what's the vehicle used for cash balance plan? So maybe you could go back and walk us through that first part of the cash balance plan, what that vehicle looks like.
Yeah, I mean, the investment vehicles, basically you set it up in a brokerage account. That's what we do. You set it up inside there and you build a portfolio. And typically you want to have a cash balance plan. It's more your more conservative strategy. That's how they're designed. You want to average about a 4% return. We typically build those out or recommend and build those out. We use Fidelity, BlackRock, American Funds, and Vanguard to put those portfolios together to get the steady return inside there. But
that's a separate plan, Mitch. It's not your 401k plan. It is it's another plan.
Yeah, it is another plan. It's a pooled account, and that's the reason you use a third-party administrator, because you wanted these designed right, a TPA, to do that. But it is a pooled account, a separate account. It doesn't show up on your 401k statement. You get a separate statement. Each individual does. That's part of that cash balance plan each year.
And it has its own set of rules, similar to a 401k plan that you got to follow to have it qualify. And
yeah, there's similar rules inside the cash balance plan as there is in the 401k too.
So Catherine, think of it as a bolt-on to your already current 401k. It's just an add-on that's on there.
Yeah.
Are there any other questions from the audience on anything that they've covered or anything that maybe they haven't covered? That would be helpful.
I'm not really seeing other questions in there. Well, if you think of other ones outside of this, you know, Katie will have our information that you could reach us and get a hold of us or go through resultants, and be happy to help you discuss any of those topics.
Great.
Thanks everybody for joining. We appreciate resultants and having them set this up. I'm happy to help.
There's another question.
There is one snuck in there.
Oh.
Do you see any more finance coming for small businesses next year? Do you see any more finance coming for small businesses next year?
I think we have to wait until next week. We'll have a better answer, as well as I think once we get past the election, then they can actually start doing the work they're there to do. without having to worry about who they're ticking off and whatnot. So hopefully we'll have some more answers by the end of the year, because there are a lot of things open right now, PPP and otherwise. And the pandemic, some companies are planning for changes all the way into June next year already. So they got to do something past 12/31. Otherwise, we're going to be hurting come January 1.
John, have you been hearing things that they might be looking at?
Yeah, we've heard, more rounds of PPP funding, more grants, subsidies to specific areas around the U.S. that have been harder hit through hotspots and whatnot. But all that's kind of talk at this point, but I think politicians are throwing those out so that way they know elections are coming here. So they want to appease to the most group that they can.
So early on, the talk was, let's get some stimulus checks out to the people because everybody needs money, right? The part of the PPP funding was they made no requirements whatsoever. They didn't add any stipulation that you needed the money. Just due to these uncertain times, could it be realistic that you could use money or need money at some point? Well, realistically, that applied to every company in America, other than the ones that were too big, that wasn't meant for them, right? So some of the things I've heard, and we do have some of the tax team listening in on some of the House and some of the representative meetings and hearing what they're talking about. Well, some of what they were talking about was trying to identify segments of people that actually need the money, right? We know the food service and that part of the country's really been hurt most. They're not open, or now they're open, but people still aren't coming back and going out and eating, or you have limits to how many people could be in the restaurant and whatnot. So they were talking about maybe trying to direct money to specific need groups, but who's going to say you're in that group and you should get money, but the neighbor next to you, he doesn't get the money? So, I mean, that's what they avoided in the first go around. So it wouldn't surprise me if they just let it go after this, but I think everybody's right. It's going to depend on what's the outlook look after the election, and quite frankly, how fast they can get vaccines and different things ready for the general public, so people can feel safe to be traveling around and doing what they want. So no crystal ball on that one. Mitch, you want to stick your neck out, say who's going to win elections? No.
It's supposed to warm up next week.
60 degrees, I hear.
So there's another question in there. That's kind of like that crystal ball,
I was going to say the same thing.
Yeah, it's tough to know if they're going to do anything. They're so far apart, and there are certain sticking points with what they're working on right now. In terms of state funding and some other things that they're both very far apart on. So it's really hard to know if they're going to actually come together. And we don't know what kind of turmoil there's going to be following next week. The election could be undecided for months. We don't know. And so, it really depends on, at some part, you never know. If people are already on their way out, they might be ready to make a deal, because then they don't have anything to lose. So
effective change and long-term change really doesn't come about in these short-term periods. If something was going to fall in that period, it would have already been worked on. Mitch can speak a little bit about what the markets look like, from changing in presidents or changing in elections, how that affects the markets over time.
Yeah, you look over the last 8 presidents, an interesting piece. All 8 presidents except one have averaged just under a 9% rate of return. Whoever the president is, they don't want to have a bad economy. They want to go out and make sure they have a strong economy. They're not going to try to flush it down the toilet. The only one president that had a negative year over the last 8 presidents was George W. Bush. And unfortunately, he came in right after the dot-com boom, and he left after 9/11. So he came in 2 critical times. He came in and left after 2 critical times. So presidents are not going to come in and want to have a bad economy. They don't want to be reminded of that unless there's a cataclysmic event. So I think that we as an American, as far as companies go, we'll weave our way through the different pieces that are put before us.
Yeah, the GDP spend is what they measure how people are spending money, and if you graphed it out, what Mitch is talking about, all those presidents, the line just goes just like this. One little blip when GW had that little drop, but other than that, the line just keeps moving. So, and everybody gets a little worked up about, well, what if the White House changes? Economically, it really doesn't change anything for most people. It just keeps moving ahead, right? The country keeps growing. We keep spending more money. Now, looking at tax side of things and whether you get anything done, I haven't really seen many presidents move quicker than Trump has, and as far as shoving stuff in and getting it done fast. Took him till 2018 to get a tax change in place. It took him 2 years. So I don't see much happening, whether there's a change in the White House or not in the next short run anyway. Economically, I've sat through a couple classes in the past few weeks of economists trying to predict what they think's happening. All the indicators, they look at 3 or 4 different or 13 different indicators, and all 13 of those indicators were green, meaning everything looks like it's going to be moving ahead. If you look back at the last recession back in 8 and 9 when things were bad, all those were red indicators because things were bad. We didn't have that going into COVID, and we don't have that coming out of COVID. So, some optimism there that things are still good. They thought, an improvement in the fourth quarter, which is easy to do because, the second and third quarter weren't great. Fourth will be better than those. But next year, 2021, the talk was that's a growth year. 2022 is a growth year. After that, we'll wait and see. Then the impacts of maybe the change in the House or change in the White House, those type of things, when they're talking tax changes, that's when you see a couple years out. People have been worried about the spend, and we're burning through money. The government just keeps spending it. But the economists said the interest rates are so low. U.S. never pays its bills. It never pays its debt back, right? We just have to worry about the interest. Well, we grew the debt so much, that's concerning, and that is a long-term concern. But in the short term, you're only paying interest, and we're not paying as much as we used to. So with interest rates down, the U.S. is actually doing better because of this. But it'll catch up to us eventually. Don't get me wrong in that piece of the conversation. But in the short run, nothing that's going to hurt day-to-day stuff. So
good question.
A little positivity there.
Great. All right. Well, thank you so much for this presentation. I thought it was super informative, and there's lots of great stuff that you guys covered, a wide array of topics. So I think it was very helpful. I hope that.
Thanks for having us. Thanks for hosting Resultants. This is a great forum, and happy to be a part of it. Thank you.
Yeah.